Joining me now is Brij Khurana, Wellington fixed income portfolio manager. Brij, what do you expect to really move the bond market tomorrow? I mean, assuming we get the quarter point everybody expects, there's going to be a lot of contention among the Fed voters, possibly more than we've ever had.
Yeah, no doubt. I mean, I think we are definitely going to get that 25 basis point cut. I think there will probably be 3 dissents, to your point, asking for 50 basis points. What the market's really going to focus on is what we call the summary of economic projections. And so here what we want to see is the dot plot. And this is basically where the Fed gives its prognostications on where the policy rates can end this year and then next year. I think this year they're going to indicate about 3 cuts to the policy rate. But what might be a disappointment to the market is next year, the market's already pricing the Fed getting below 3% or almost 150 basis points of cuts. I find it really difficult to move that dot from 3 5/8 all the way sub 3%. So I think that might be a little bit of a disappointment to the market, even if they acknowledge that the labor market is weakening. That's what the bond market's going to be focused on.
How have you seen the president's efforts for more influence, let's just say, in the Fed affecting the bond market?
So, what I would say is it's priced into what we call term premia, which is the value in extending out the bond curve. And I guess when I think about where there is value in the bond curve, it is actually out the curve. There's a lot already priced into the Fed cutting pretty dramatically over the next few years. But when I look at forward rates, and that's important to look at forward rates when the yield curve is as steep as it is, and you look at Treasury bonds, the market's basically saying that 10 years from now, 10-year Treasury yields are going to be close to 5.5%. I mean, that's the highest we've had in 20 plus years. And so I do think the market almost is pricing in term premia, and in some ways almost too much term premia. There's a lot of ways I could see that come down. I don't imagine that we're going to see 5.5% growth for the next 20 years. And so I do think there is value in the bond market at the end of the curve.
Which do you see as a bigger weight in fixed income markets right now, the expected rate cuts or a consumer that's going to be having a harder time getting a lower mortgage, or based on the FICO data that we got today, maybe continuing to pile on debt?
Well, I mean, I do think that you are talking about an economy that's 2 speeds in some ways. So you have high-income consumers that are continuing to spend. You saw that in the retail sales data today. And that's really what's making the inflation story tricky. And, I do think that high-income consumers keep spending. And if you look at core inflation and take out shelter, it actually grew at 2.7% last month, which was the highest level in the last 2 years. And so high-end consumers doing well. Who's suffering are small businesses where interest rates are still too high, and you do see them firing, and you do see, the unemployment rate move higher as a result of that. So it really is a 2-speed economy, and that's what makes the Fed's job so difficult. Is who are you trying to help here? In this case, lowering rates does help small businesses, but it could increase the wealth effect, which also makes inflation stickier.
So what kind of impacts does the bond market expect to see from a Fed rate cut, and what do you view as the chances that we don't get those reactions?
Yeah, I mean, when I think about, once again, what's priced into the front end of the curve, it's really expecting the market, the Fed, to cut pretty drastically. And I do think that, in some ways we are in this Goldilocks type environment where the market's saying, yes, growth is slowing. Yes, the unemployment rate's moving up. But the Fed is going to be so aggressive with a new Fed chair at some point next year that they're going to save the cycle and prolong the expansion in a lot of ways. And I guess what could really throw that consensus off is if inflation does start to pick up. And I think that's where it makes sense for, diversified investors to really think about inflation-linked bonds, because it's one area where the market's already pricing in, the Fed getting back to that 2% target. And it may very well get there. But what ends this Goldilocks story is really if inflation picks up. And so right now, I think, you can buy long in real yields. Inflation-linked bonds are tips, about 2.5%. I think that's pretty attractive.
How much does tariff policy and tariff impacts measured in the data matter to the fixed income markets?
So I think it matters a lot. And I guess it's a surprise it's not in real yields. And, I do think there is this narrative out there that we haven't seen tariffs affect inflation. And I think that's just not true. I mean, if you look at what we saw, core goods increased about 0.3% month over month last CPI print. And so we are seeing that inflationary impulse move in. But when you think about tariffs, you think about immigration, in some ways there's somewhat both stagflationary policies. You should expect lower growth and higher inflation as a result. And once again, the way to express that is through inflation-linked bonds.